You know that feeling when you finally get a raise? You're excited, you're proud, you're thinking, all right, this is it. Things are finally going to feel easier. Your paycheck goes up a couple $100 a month, you start breathing a little easier, maybe you upgrade a few small things, and then a few weeks later, you're looking at your bank account like, wait, why does this still feel tight? Why am I not actually getting ahead? And if you're in that $40,000 to $60,000 income range, you might even notice something weirder. You get a raise, and somehow you're taking home less help with healthcare, less in tax credits. Maybe you lose a discount on your kid's daycare or your student loan payment jumps. And now you're wondering, did my raise actually make me poorer? If that sounds even remotely familiar, listen closely, because this video is literally about you. My name is William, and I spend way too much time thinking about the little-known benefit cliffs in the $40,000 to $60,000 income range. If you're someone whose small raises can cost you thousands in healthcare subsidies, tax credits, and assistance, secretly making you poorer, be sure to subscribe and like this video if it helps you. Here's the thing. We've all been told the same simple story. Make more money, life gets better. End of discussion. But for a huge chunk of people in that 40 to 60,000 range, the math is a lot uglier than that. You're not just moving into a higher tax bracket, you're stepping off a cliff. And here's what most people don't realize. Between federal income tax, state tax, payroll tax, and the way benefits drop off, some people in this income band are effectively paying a higher marginal tax rate on their next dollar than many millionaires. That sounds dramatic, so let me back it up with real numbers. According to the Congressional Budget Office, some low and moderate income households face effective marginal tax rates above 70% once you include taxes, plus the value of lost government benefits. The University of Chicago has found similar patterns. In certain income bands, a family can lose 50, 60, even 80 cents of every extra dollar they earn. So if you've ever felt like you're running in place financially, you might not be imagining it. The system can literally be working against your pay raise. Let's break down how this actually happens, because once you see it, it's going to change how you think about raises forever. First, quick definition. A benefit cliff is where earning just a little bit more money causes you to lose a lot of assistance. Think of it like this. Imagine you're walking up a staircase. Every step is another $1,000 of income. If we were in a normal world, each step would give you a little more money after taxes. Maybe not a lot more, but a little. A benefit cliff is when one of those steps, instead of leading to a higher landing, it drops you into a hole. You step up $1,000 and you actually end up worse than you were on the step below. Now, let's walk through a realistic example. Say you're making $42,000 a year. You're single, no kids, and you get your health insurance through your state's Affordable Care Act marketplace. At that income, depending on your state and age, it's totally possible you're getting, let's say, about $350 a month in premium subsidies to help pay for your health insurance. That's $4,200 a year. Now your boss gives you a raise. Awesome. You go from $42,000 to $48,000. That's a $6,000 raise. On paper, this looks great. But here's where it gets really interesting. As your income rises, those ACA subsidies shrink. According to data from the Kaiser Family Foundation, moving from the low 40s to the high 40s can easily reduce your premium tax credit by over $2,000 a year, depending on your plan. So you gained $6,000 in salary, but you just lost $2,000 in subsidies. Now you're effectively only up $4,000. Then we stack on taxes. That extra $6,000 is taxed at your marginal tax rate, not your average rate. Let's say between federal, state, and payroll tax, your marginal rate is around 25%. That's pretty typical in this band. 25% of $6,000 is $1,500. So watch this. $6,000 raise minus $1,500 in extra taxes minus $2,000 in lost health subsidy, you're up only $2,500 for the year. That's about $208 a month. And here's what most people don't realize.
If any other benefits are tied to your income, like student loan payment calculations, certain tax credits, or local assistance, you might lose even more. It's not crazy to see a situation where someone gets a $6,000 raise and ends up with maybe $100 a month of actual wiggle room. Now, that's for a single person. Let's talk about a family, because that's where things can get really brutal. Picture a married couple with 2 kids. They're at $50,000 combined income. Between the child tax credit, earned income tax credit, and healthcare subsidies, they're getting a decent amount of support. I'm going to keep the numbers simple, but the pattern is real. At $50,000, maybe they qualify for $4,000 in child tax credits, $1,500 in earned income tax credit, and $3,500 in ACA subsidies. That's $9,000 worth of tax credits and benefits. Now one spouse gets promoted. Great news, right? The household income jumps to $60,000. Here's the cliff. At $60,000, a chunk of that earned income tax credit can phase out. Some or all of the child tax credit might be reduced depending on the year's rules and how many kids. The ACA subsidy shrinks again. It's very possible that their total credits and subsidies drop from $9,000 down to $4,500. That's a $4,500 loss in benefits. They got a $10,000 raise, and after just that one change, they lose $4,500 in assistance, and they pay maybe $2,500 more in taxes on the raise. Their $10,000 raise just turned into a net gain of $3,000. That's $300 a month for a full family after a seemingly big raise. Now, that's the math part, but I want to talk about the psychology, because this is where people really get trapped. When you hear, "I got $10,000 raise," your brain doesn't think in after-tax, after-benefit numbers. It thinks, "I am $10,000 richer. I deserve to live like someone who makes 60 grand, not 50. That's a psychological anchor. So what happens? Lifestyle creep, a slightly nicer car payment, slightly more expensive groceries, maybe eating out more because, hey, we can finally afford it. Meanwhile, your net gain is actually $300 a month, not $800, and you've already committed to $700 a month in new expenses. So, on paper, you got a raise, but in reality, you just locked yourself into a tighter budget, and now you feel poorer, not richer.
Now, you might be thinking, okay, William, are you seriously telling people to turn down raises, to stay broke, to keep benefits? No, absolutely not. Over the long term, higher income plus smart planning absolutely beats staying stuck. The problem is not the raise. The problem is going into it blind. What I'm telling you is, if you're in this $40,000 to $60,000 range, you cannot treat a raise like found money. You have to treat it like a chess move in a very rigged game. So let me give you some practical steps to avoid this trap and actually keep more of what you earn. Step 1. Map your cliffs. You need to know exactly which benefits, credits, or programs are tied to your income and what the cutoff points are. Do you get ACA subsidies? Go to healthcare.gov or your state marketplace and use their estimator. Plug in your current income and then plug in a few hypothetical numbers, $45,000, $50,000, $55,000, and see how your net premium changes. Do you get the Earned Income Tax Credit or Child Tax Credit? Use the IRS ETIC Assistant and some simple online tax calculators to see how those credits change as your income goes up. Do you have income-driven student loan payments? Log in to your loan servicer and see how your payment is calculated based on adjusted gross income. A few thousand more AGI can bump your payment significantly. This is not fun, but if you spend 1 hour doing this, you'll know exactly where your personal cliffs are. Step 2. When you're offered a raise or extra overtime, run the after-cliff numbers, not the headline numbers. Let's say your boss offers you a $4,000 raise. Instead of thinking, nice, that's about $300 a month, you ask, what does this look like after tax, after benefits, and after my student loan payment adjustment? You might find that the real number is closer to $120 a month. Still positive, still worth it, but now you're not going to go out and sign up for a $250 a month car payment based on imaginary money. Step 3.
Use the rules in your favor with pre-tax contributions. This is where it gets really interesting because you can sometimes dodge a cliff without turning down income. A lot of these benefit formulas use your adjusted gross income, not your gross pay. That means money you put into a traditional 401k, a traditional IRA if you qualify, or a health savings account can actually lower the income the government sees. So imagine you're at $48,000 income and bumping to $50,500 would push you off a big ACA cliff where you lose, say, $1,500 in subsidies. Instead of saying no thanks to the raise, you could accept it and then increase your 401k contribution by $2,500. Now your gross income is $50,500, but your adjusted gross income comes back down closer to that $48,000 level. So you stay under the cliff, you keep the subsidy, you get the retirement savings, and you still take home a little bit more. You basically turned a dangerous raise into free retirement money. And remember, that 401k contribution isn't lost. It's still your money, just future use money instead of today use money.
Step 4. Plan for jumps, not drips. The most painful situation is when your income creeps up slowly, 1,000 or 2 at a time, and each small step costs you benefits, but never quite high enough to feel dramatically richer. In that case, you're hitting every little ledge of the cliff, scratching yourself up the whole way. If you can, try to plan your career moves around bigger jumps that clearly clear the cliff. So if you're at $42,000 and you know that around $48,000 to $50,000 your health care and credits drop, your real goal isn't 48, it's maybe 65. At 65, even if you lose a few thousand in benefits, the net gain is large enough that you can genuinely feel it. You're not just treading water. Now, obviously, not everyone can magically jump 20 grand overnight, but it changes how you think. Instead of just saying yes to every tiny raise or overtime opportunity, you might focus more on getting a certification, changing employers, or moving into a higher tier role that gives you that bigger move. Step 5. Guard against the psychological trap. Even if you optimize all the math, the raise won't help if you automatically inflate your lifestyle to match. So before the raise hits your paycheck, decide on a plan. For example, 50% of the after-cliff raise goes to debt payoff or investments. 30% goes to short-term goals or savings. 20% upgrades your lifestyle guilt-free. That way, you still feel the raise, but most of it is moving you forward instead of just getting eaten by subscriptions and DoorDash. Now, another objection. Isn't this just gaming the system? Shouldn't I just try to get as rich as possible and ignore the benefits? Look, in a perfect simple world, sure, but in the real world, pretending these cliffs don't exist doesn't make you noble. It just makes you broke. You don't control the rules, but you do control how prepared you are for them. Using a 401k to avoid a benefit cliff is not cheating. It's literally doing what the tax code is begging you to do, save for retirement. What is dangerous is lying about your income or working under the table to keep benefits. That's fraud. Don't do that. Use legal tools, not sketchy workarounds. The goal here isn't to stay stuck in the 40 to 60 band forever. The goal is to survive that band, build wealth during it, and then launch out of it with as much momentum as possible. All right, let's zoom out for a second. If you're in this $40,000 to $60,000 trap, here's your action plan in simple terms. 1. Identify every benefit and credit you receive that depends on income: healthcare, tax credits, student loans, anything. 2. Find the income thresholds where they start to phase out. Write those numbers down. 3. When you're offered more income, run the real numbers, after taxes, after lost benefits, after payment changes. 4. Use pre-tax accounts like 401ks and HSAs to push your official income below dangerous cliffs when it makes sense. 5. Treat raises as tools for wealth building, not signals to inflate your lifestyle. If you do that, you flip the script. Instead of raises secretly making you poorer, every raise becomes a lever you're pulling on purpose.
I know this stuff can feel overwhelming. It can feel unfair, because honestly, it is unfair that someone going from $45,000 to $55,000 can face a higher effective tax rate than someone going from $400,000 to $500,000. But you don't have to wait for the system to change to protect yourself. You can learn the rules, you can run the numbers, you can make intentional moves instead of just hoping the next raise will magically fix everything. And here's the last mental shift I want to leave you with. Stop measuring your progress by your salary and start measuring it by your net position. If your salary went up $5,000, but your net worth, your savings rate, and your stress all got worse, that's not progress. If your salary goes up, you lose a little in benefits, but your retirement accounts grow, your emergency fund grows, and your life gets calmer. That's real progress, even if it doesn't sound as flashy. So if you're in that $40,000 to $60,000 zone, I want you to pause before you celebrate or panic about your next raise. Run the math, think about the psychology, and then use that information to make the raise work for you, not against you. If this helped you see your paycheck differently, hit like so more people stuck in this trap can find it, and subscribe because I'm going to keep breaking down these weird corners of the money world that nobody else talks about. Thanks for watching, and I'll see you in the next one.